Welcome back to The Explainer. So today we are diving deep into the daily strategy report for August 19th, 2026. We're going to be acting as your chief macro strategist today, synthesizing global asset pricing models. We are cutting through all that surface-level noise to find the actual structural shifts driving the markets right now. If you're managing a portfolio, or honestly, if you just want to understand the invisible forces pulling at global capital, well, you are absolutely in the right place. Let's get right into it.
8,000. Yeah, you heard that right. That is the extremely aggressive new S&P 500 target coming out of Tier 1 global investment banks like JP Morgan and Goldman Sachs. It is a massive upside call, and it's basically being driven by this incredibly strong corporate earnings wave and, of course, the absolute beast that is AI infrastructure monetization. It's a hugely bullish signal, and it's literally sucking institutional money straight into equities.
But hold on. Immediately contrast that super bullish stock market target with this number, 4.75%. That is the surging 10-year U.S. Treasury yield, which, by the way, just hit a 20-month high. This right here, this is the core tension in the market today. How on earth can stocks be chasing record highs when the cost of borrowing is just rocketing upward and bond yields are flashing these giant warning signs? It's a massive, almost historical divergence between equity optimism and fixed income anxiety.
To untangle these mixed signals, we're going to run this through a top-down macro funnel. First, macro sentiment and the Fed. Second, Treasury and currency dynamics. Third, equity market structural analysis. Fourth, sector strategy and capital flow. And finally, strategic scenarios and our final verdict.
Starting right off with Section 1, macro sentiment and the Fed. Let's look at the foundational inflation data up against the shifting stance of the new Federal Reserve leadership. So the tone at the very top of the Fed is, well, it's decidedly firm. At just his second press conference as Fed chair, Kevin Warsh was totally unambiguous. He said, "We will deliver price stability and will not hesitate to act." Now, this ultra-hawkish communication is fascinating, mostly because it kind of contradicts their actual policy decision from July. Remember, they voted to hold the federal funds rate steady at that 3.50% to 3.75% target range. So the rhetoric is super tough, but the actual action? Yeah, they paused.
But, and this is a big but, that pause wasn't unanimous at all. There's a growing divide inside the Federal Open Market Committee. The vote was 9-3. Those 3 dissenting votes, they actually wanted an immediate rate hike. That exposes a very real, very intense internal debate going on about the trajectory of inflation and whether current rates are restrictive enough, especially when you factor in the renewed oil shocks we're seeing right now.
And here's where it gets wild. How is the market digesting all this hawkish Fed speak? Honestly, there's a huge disconnect. According to the CME FedWatch tool, the market is only pricing in a 31% probability of a rate hike in September. 69% say they'll just hold steady. So what's the takeaway? Investors are basically betting that the Fed's bark is way worse than its bite. And that is setting us up for a massive volatility trap if the central bank actually follows through on Warsh's tough talk.
This whole discrepancy, it's completely driven by these wildly conflicting macroeconomic signals. I mean, on one hand, CPI inflation is sitting at 3.4% year over year. That's the second consecutive month it's decelerated, which sure, that supports a pause. But on the flip side, man, that July jobs report was an absolute shocker. The economy actually lost 23,000 jobs. It massively missed the consensus estimate, which was expecting us to add 83,000. So we've got sticky, elevated inflation paired with a sudden, nasty contraction in employment. This is the exact nightmare complication of the Fed's dual mandate playing out right in front of us.
Moving on to Section 2, Treasury and currency dynamics. Let's really examine the foundational plumbing of global capital.
Right now, the bond market is quite literally choking on supply. The estimates are pointing to a staggering $1.5 trillion in corporate bond issuance from AI-related companies this year alone. Think about that number. This massive wave of new debt is being spun up to finance this incredible AI infrastructure buildout, and it is just overwhelming credit markets. When you have that much supply dumping into the market, prices drop and yields are forced upward, which exactly explains why we're seeing that 10-year yield pushing relentlessly toward 4.75%.
And that leads us directly to something called the term premium. Because of this absolutely unprecedented tech debt issuance, combined with, expanding government fiscal deficits, bondholders are demanding a much higher term premium. They're basically saying, look, if you want me to lock up my capital long term, while all this supply and inflation risk is floating around, you're going to have to pay me significantly more to do it. That is the structural shift we're witnessing in fixed income right now.
What this creates is a crazy tale of two totally different credit markets. On one side, you have the AI hyperscalers. They have incredibly easy access to credit, with the markets easily absorbing that $1.5 trillion issuance. But then, contrast that with the affordable housing sector. Less than 2% of Federal Home Loan Bank members are Community Development Financial Institutions, or CDFIs. Why? It comes down to structural collateral frictions. They are super reluctant to accept atypical collateral. So we're in a situation where liquidity is just flooding into big tech while completely starving community housing initiatives.
Okay, let's trace the projected path of the US dollar index, the DXY. Right now, in August 2026, we're seeing some near-term dollar weakness, mostly due to moderating inflation and a really high global appetite for risk. But strategists are projecting a structural bottoming out, with a robust, long-term recovery starting right around January 2027. The reasoning? Stronger U.S. economic growth is going to pull capital back in. And crucially, the looming French presidential election in April 2027 is expected to trigger some massive political risk and euro weakness. That's going to create a really powerful floor for the dollar.
All right, Section 3, Equity Market Structural Analysis. We really need to look at why the stock market is completely ignoring the immense pressure of those higher bond yields we were just talking about.
The answer here? It all comes down to the undeniable underlying micro-fundamentals of the tech giants. Just consider the Q2 revenue growth for these major cloud providers. Google Cloud, up a mind-bending 82% year over year. Microsoft Azure is up 43%, and Amazon Web Services is up 37%. This is unprecedented. It's massive earnings growth, and it's hard, concrete evidence that AI monetization is real. This fundamental strength is essentially acting as a giant gravitational pull. It is single-handedly lifting the broader S&P 500 index upward, completely shrugging off all those macro headwinds.
But, and this is crucial for your portfolios, we're actually seeing a structural rotation happening right beneath the surface of the index. We're transitioning out of phase one, AI concentration, where all the money just flooded into the Magnificent Seven tech giants who were building the actual infrastructure. Now, we're moving into phase two, AI breadth. Institutional capital is rotating toward the companies that are actually implementing this AI to drive real productivity gains. A prime example? John Deere. If you're an institutional manager, monitoring this flow of capital toward these phase two beneficiaries is absolutely critical for generating alpha in the coming months.
That brings us to Section 4, Sector Strategy and Capital Flow. Let's track exactly where the smart money is hunting for returns and where they're hiding out.
A really massive story today regarding unique, idiosyncratic alpha is happening over in the healthcare sector. Get this, Moderna shares just surged an incredible 63%. They added nearly $15 billion in market cap in a single day, while Merck jumped almost 8%. This is entirely driven by a historic breakthrough in a phase 3 trial. They combined Moderna's individualized mRNA cancer vaccine with Merck's Keytruda, and they are seeing a dramatic reduction in the risk of recurrence or death in melanoma patients. They are literally sequencing a patient's DNA and training their immune system to hunt down the specific tumor. It is a jaw-dropping demonstration of the future of medicine, and capital is flowing heavily into this space.
But simultaneously, we're seeing institutional money flowing hard into defensive commodities. Why is that? Well, it's a chain reaction. Step 1, we have this intense geopolitical deadlock in the Strait of Hormuz, which leads directly to Step 2, oil hitting a 2-week high on severe supply fears. And that brings us to Step 3, the ultimate defensive hedge. Central banks just accumulated a record 288.9 tons of gold in the second quarter. Institutions are hoarding commodities right now as a necessary hedge against sudden geopolitical supply shocks, and obviously any resurgent inflation that might pop up from those higher energy costs.
Finally, Section 5, Strategic Scenarios and Verdict. Let's translate all this heavy data into some concrete, actionable portfolio adjustments.
All right, here is our final strategic action plan. Our overall verdict? We're bullish. We are echoing those Tier 1 bank calls for a 12% upside in the S&P 500 over the next 12 months. Because of that, the recommendation is to remain overweight in U.S. equities, specifically targeting those Phase 2 AI implementers we talked about. Conversely, though, we recommend an underweight position in core fixed income. There's just too much ongoing corporate supply pressure forcing yields up. You'll want to keep commodities and cash at equal weight for hedging purposes. And the main technical metric you need to watch? Keep an eye on the VIX stabilizing near that 15.43 level. That's your signal that this tectonic bull market still has plenty of room to run.
But before we wrap up, we absolutely have to talk about tail risks. Because while the market is eagerly chasing that 8,000 target,
You really need to ask yourself, is your portfolio adequately hedged against a sudden closure of the Strait of Hormuz? Honestly, it is the market's most ignored black swan event right now. If that energy choke point shuts down, the entire inflation narrative flips on its head overnight. So, stay constructive, stay bullish, but whatever you do, do not be complacent. Ruthlessly review your defensive positioning. Thanks so much for joining me on this explainer. Keep learning, and I will see you next time.